Awesome. Thanks, Damon. It's a ton of fun to be here. I've not necessarily participated full-time in an AEC hackathon, but have kind of come in and out of various ones. And it's always fun talking to all of the people who, are very interested in helping change the way that we do construction. So here we are. We'll get started with the presentation. So just in terms of brief agenda, I think it's worth kind of telling you a little bit about Brick and Mortar Ventures, just to provide context as to why I or Brick and Mortar Ventures may be a credible source for this information. And I want to start off with talking about venture capital before actually jumping into, the tips for starting a company in AEC, just because I think it's worth. If you're thinking about starting a company, I think it's worth understanding what is venture capital and kind of all of the strings attached when you look at raising money from venture capital firms. So just as a brief intro to Brick and Mortar Ventures, these are our missions and values. So really, we want to be a global design, construction, and asset management technology investor and trusted partner to industry leaders. So we do focus on the global construction market. So we invest globally, and we like building relationships and partnerships with kind of the startups, as well as contractors, owners, and all the industry leaders, regardless of whether or not they invest in our fund. This is our team. We're a very small team. There are only 5 of us. I'm not going to go through all of the introductions, but you can see that, with some of the logos on the bottom, 4 out of the 5 of us have direct AEC operations experience. Austin, his family does land development, so he's kind of grown up around that business and really helps round out the team's experience, kind of covering all of the different market verticals that we invest in. So we invest in what we call the construction process, and that starts with design through pre-construction, construction, handover, commissioning, and operations and maintenance. And this is the construction process across all the different market verticals. So from your single family residential to commercial projects to oil and gas, civil infrastructure, hospitals, data centers. Should people start building out in space, we would love to invest in space construction companies because it is that process of construction that we're really investing in. And just a brief background on myself, I worked for DPR Construction for a number of years before joining Brick and Mortar Ventures. Most of my experience is in construction operations, and I spent a lot of time working with startups. While at DPR, got pulled into a lot of things that had to do with BIM, worked with laser scanners, point cloud data. When iPads were first invented, spent a lot of time also looking through, what was in the App Store, what could we use, and really focus on bringing a lot of the technology into the field and helping make communication a lot more efficient between the field and the office. And just to tell you a little bit about our investors, so the investors in the Brick and Mortar Fund are these, very large, multi-billion-dollar companies in the construction value chain. So they're all, big names. I'm sure you've all seen these logos before. I do want to caveat that Bechtel is not a direct investor in our fund, but because our managing director is Darren Bechtel, we do work very closely with the Bechtel company. And these are these are all of the portfolio companies of our fund. So these are all the companies that we've invested in out of our first fund, just to give you a sense of the types of companies that we look to invest in. So you could kind of see there's a pretty wide range from, pure software only platforms to tech-enabled contractors to hardware companies. So we kind of invest in all different types of business models, but all focused kind of within that construction process. And this is just, an image showing a lot of the other companies and corporations that we work with outside of our limited limited partners and the preferred industry partners program. And these are all, great companies that provide us insight with what types of problems they are motivated to solve. And there's also a lot of kind of cutting edge technology that's being developed out of these research labs. There's a lot of great research out of the universities. Through our associations, we get to meet with and learn about a lot of very early stage construction companies, and also facilitate introductions to others in that ecosystem, and really try to help be a network for everyone in the AEC space. So now diving into what is venture capital. So kind of want to start looking more at the right-hand side before diving into the left-hand side. So typically, when you think about starting a business, you look at, all different types of funding options. I think traditionally it's been going to a bank and getting a type of loan. And this is in particular for companies that have been started in the AEC space. So if you think about, starting a contracting firm, or starting an architecture studio, or an engineering consultancy, a lot of those folks have, taken out, a loan against a mortgage, or they've taken out some type of loan from a bank to start that type of business. So contrary to that, when you're talking about a startup that wants to go, a startup, particularly a technology related startup, those characteristics are so different from starting kind of a traditional business in AEC that I think it's worth kind of understanding those differences and the nuances. So for startups that are going after venture capital, a lot of the times they can't get a loan from a bank. And a lot of that has to do with not being able to generate near-term cash flow. So if you think about, a company like Uber, their focus was on growth, and they weren't profitable, and currently still not profitable. But, there was a long period of time in the life of that company where they just were not able to generate positive cash flow, and they weren't able to kind of become profitable in the early couple of years. So for companies like that, banks think it's way too risky, so they're not going to be able to feel good about giving a loan to this type of business. And when it comes to going after venture capital funding, I'll talk a little bit about this later. Kind of depending on how that fund is set up, there's a payback period, and the venture capital firm needs to pay back their investors. So looking at the exit strategy for a type of company is pretty important. And that exit strategy is either an acquisition by a larger company, or going into the public markets and raising money. So that's the IPO route. So kind of having that in mind, it's a pretty kind of different business characteristic than a type of company that is more kind of slow growth, maybe organic growth, and being able to take out a small enough amount of money that can really focus on turning that business into a profitable business in the near term. So when it comes to venture capital, it's another word for it is equity financing. So you're basically giving up a piece, a percentage of your company to the investors to get that money. So I think, especially here in Silicon Valley, I feel like there's a misconception of venture capital that, it's easy to get, maybe there's, not, maybe it sounds like free money, but it's not. You're basically giving a percentage of your company away to investors to kind of borrow that money. So this is a general kind of flow of venture capital, and I'm trying to shed some light on how the money works. So if you look at the left-hand side, this is a generic example of what that looks like. So the investors in a venture capital firm are called limited partners. And those are, pension funds, big companies, family offices, all different types of, big money managers. They invest in a firm like us, Brick and Mortar Ventures, and we are the money managers for those big corporations or pension funds. So it's, you know, another layer below, and it's a different kind of asset class when it comes to investing. And then for us, the venture capital firm, we then get to invest that money into startups. And when the startup receives money from us, we call those startups a portfolio company. So just on the right-hand side, that's an example kind of using real life logos and you know, real LPs of ours and real portfolio companies of ours. And I think for us, a key thing to point out is that, you know, although we're all in construction, because we're kind of that middle layer between the LPs and the portfolio companies, the portfolio companies are not responsible for any type of, you know, strategic initiative of the limited partners, and our limited partners are not responsible for, you know, any of the success of our portfolio companies. We kind of just all share that common goal of helping move the construction industry forward. And I think this is important for founders to understand when you're thinking about starting a company. I think it's, you know, worth noting, you know, why do certain venture capital firms invest in certain types of companies? And a lot of it is that, you know, venture capital firms are financially driven to make those investments. So how does a VC make money? So if you look at the left-hand side there, this is a typical VC fund structure. So typically out of the money that gets invested into a firm, 2% of the money invested goes to management fees, and this is on an annual basis. There's a 20% carry fee or carried interest, and this is, I would call it like the profits of a venture capital firm. And then a typical fund life is 10 years. So for a $100 million fund, this is just an example, 80% of that fund gets to go into investments, and approximately 20% of the investment goes towards management fees. So when you're thinking about, you know, raising venture capital, it's good to understand from the venture capital firm's perspective, you know, how much capital have they deployed, how much money is left, and where they are in the fund life, just to get a good understanding of, you know, if later on you need additional money, how much they have kind of allocated for follow-on investment. So there's a lot of stuff here. I'm going to keep this kind of more introductory. So if you have questions on that, definitely feel free to reach out and I can answer any questions there. So just to kind of, you know, make this a little bit more real life, I put a pretty generic example on the right-hand side. So for that $100 million fund, as shown on the left, 20 million approximately in management fee, $80 million is left for investing in startups. So after the 10 years, just as an example, say that VC invested in 20 portfolio companies. Of course, not all 20 of them make it to an acquisition or an IPO. In venture capital, a lot of those portfolio companies end up failing, which is why when an investor looks at investing in a startup, they'll kind of think through, you know, does this startup have the opportunity to provide at least 10x return on investment? But of course, you're aiming for, you know, the 1,000x, 10,000x return on investment when you're investing at an early stage. So just as an example, say of those 20 million portfolio companies, some of them kind of disappeared, some of them got acquired, and, you know, none of them IPO'd. So the returns, as an example, so say that they returned $350 million to the fund. So if you kind of look at the math below, the returns for the LPs are actually 300 million, because you know, you have to give them back the original investment of $100 million, and then because the profits for the VC, the 20% of what's left over, that's 50 million. So you do the 250 minus the 50 million, so the 200 million plus the 100 million goes back to the LPs. And I could explain this a little bit better. I know that the numbers are not shown in the best way right here. So The profits for the VC is $50 million, and typically, depending on how that firm is split up, or it's usually what the general partner, how they want to kind of set up the firm. You could kind of think of it like a startup in the sense that there is profit sharing for the team. So that $50 million is then split amongst the team. So just kind of, this is highlighting, why it is important for the venture capital firms to invest based on financial returns. And as a founder, you can kind of understand, why when you're talking to an investor, they're looking for that 1,000x return, or like that big company that's going to become a unicorn, because what's in it for them is if your company does well, they also get a higher profit. So I want to talk a little bit about the difference between institutional venture capital and corporate venture capital. So because startups in the AEC space it's still fairly new. If you look at, maybe 5 to 10 years ago, there were just a handful of startups in the space, and this is more on the construction side. I know for the design side, there have been a lot of startups since the beginning of Autodesk. So I would say from the design side, there's probably been a lot more kind of activity in the space, but more for the construction side, a lot of the money going into that space and the number of companies in that space is still fairly small, and only kind of happened within the last 5 years. So because of that, there aren't a lot of institutional venture capital firms that kind of focus on AEC. So even today, looking at the landscape, there's only a handful of venture capital firms looking at the built world, like Brick and Mortar Ventures. So with that, there's also a lot of large companies that see the need for technology and innovation in the construction space. So the corporate venture capital firms tend to be set up in a different way where, just as an example, there's, a big company like Cemex. They've created a group within Cemex called Cemex Ventures that invests in startups, and they have kind of different criteria when they're looking at investing. And I'll kind of talk through this to help kind of shed some light on the differences. So let's start with the institutional venture capital side. So the types of offerings from this VC, they could, of course, give you capital to start your company or to grow your company, happy to provide advice on what might be interesting go-to-market strategies or business models, or how you want to grow that company. They could definitely help with hiring. A lot of startups need different types of talent as they grow, and that venture capital firm, a lot of the times they have a network within whatever space that you're focusing on, and they could definitely help facilitate some of those introductions or provide some type of feedback on what may be some of the missing skill sets for that startup. And in terms of evaluation criteria, because the institutional venture capital firm is financially driven, they would look at kind of different stuff from the CVC. So definitely looking at the total addressable market, how big is that market, and if this startup basically took over that market, how much money can they make on an annual basis, or looking at different kind of adjacent industries and stuff like that, and kind of understanding if this company took over, how much revenue can they have on an annual basis. Another evaluation criteria is the founders. So really kind of understanding, the founders' backgrounds, different types of skill sets, like, do they tell a good story? Do they have, experience in this space? And I'll kind of cover some of this stuff in the later slides. For the startup, we also look at scalability. How easy is it going to be for this company to basically grow and or replicate, this same idea around the US and around the world? And returns. So I mentioned in the previous slides that, you know, the institutional venture capital firms are financially driven. So doing an analysis on, you know, what is that potential return on an investment? And for the returns, so looking at, you know, just one section below, I would say we typically say that we are aiming for at least 10x, but of course, you know, we're looking for those unicorns. So the unicorn is the term that, you know, the company is valued at $1 billion. And traditionally, or I guess not traditionally, but in the last, you know, we've only seen a unicorn in the construction tech space in the last 5 years or so. So, you know, if you look at the AConnect's acquisition by Oracle, I think that was $1 billion. So there haven't been that many unicorns in the AEC space. And with Procore filing to go public, I think that was most recently I've seen like $4 billion valuation. But of course, this is all kind of based on today. This is probably going to change a lot moving forward. So I think the key takeaway is that for the institutional venture capital firm, they are financially driven. So now in the corporate venture capital firm, in terms of offerings, you know, it's pretty much the same when it comes to capital and advice. A key differentiator is that they have access to users and can provide the startup with pilot projects because these CVCs are linked to some large company. A lot of the times they are or work with the innovation groups and they have a really good understanding of all the projects and all the processes. And a good CVC can actually provide you, you know, with more customer feedback through the pilot projects, or just allowing the startup access to the end users to continue to kind of grow and build the company for those users. So their evaluation criteria is a little bit different depending on the CVC setup. A lot of the CVCs kind of look at, you know, what is the impact of this particular startup to my business? So if you look at, you know, just as an example, a scheduling tool, a general contractor with a CVC may be more inclined to invest in that type of company because they get early access to that type of technology. And from the business perspective, if they're able to basically make that scheduling process a lot more efficient, that's a bigger impact on the business than, say, you know, the dollars or the returns that that particular startup may be able to bring back to that business. They also look at scalability from a implementation standpoint throughout, you know, their projects or throughout their business. So scalability is important too. Nobody wants a type of technology where, you know, you take, you know, 2 weeks to implement on every single project. So if you think about, you know, if you're a general contractor, you can't afford to take the time to basically spend 2 weeks every time you want to implement this technology. For large companies, they do look at the stability of the startup. The worst case scenario is, say, you know, you've implemented this startup on 20 projects, and all of a sudden that startup, you know, can't raise any more money and it ends up disappearing, and then all of a sudden that large company is left with some type of technology that's not going to continuously get updated. It's not going to get the support that it needs. So that brings me to customer support. Is for the CVC, they do need that support from the startup when it comes to, you know, any of the pilot projects or implementation, and they do care that, you know, the startup has the resources to help answer the questions or to basically help with the implementation, because that CVC can't be kind of a point of contact every time something goes wrong with that particular startup. So from a returns perspective, the CVCs, a lot of the times they'll get, you know, a ton of return on efficiencies in the business processes. So all of the labor hours saved, you know, that is in itself is a big return. And then depending on the CVC, they have different mandates. Some of them don't care about financial returns. Some of them, you know, aim for kind of a middle between, you know, no returns and institutional venture capital. Some CVCs are also set up and incentivized to also look at financial returns and aim for the same type of returns as an institutional venture capital firm. So with the CVCs, they're kind of a lot more flexible with the way that they operate. But I think the key thing to note is a lot of them are more strategically driven rather than financially driven. And I would say Brick and Mortar Ventures is kind of like in between both. We are financially driven, but strategically driven in the sense that we're so focused on AEC. And we have, you know, a network, and because of kind of our previous lives in the construction space, I think we've all kind of been, you know, entrepreneurs in some sense, and have kind of, you know, wanted to give back to the industry. So just as an example of a CVC, one of our investors is Haskell, and they have a group, Disrupt Tech, that is evaluating and investing in a lot of construction technologies. So Disrupt Tech, a couple months ago, I think, started, you know, sharing their thoughts about, you know, all of the different types of technologies that they've tried out and utilized on their projects. So they've started the uptake, a lot of great information on there. And you could see on the bottom right that they've also been piloting a lot of startup technologies. So I would say they're one of the great partners to have in the CVC sense. And then now we get into tips for starting a venture-backed company in the AEC space. So I think, you know, before you even think about starting some type of venture-backed company, there are a number of questions that you probably want to think about. A lot of the times we've found, you know, people starting companies that just aren't a fit for venture capital. You know, those types of businesses may make more sense, you know, getting grant money to get started with, or it's more of a lifestyle business. So I think it's really important to kind of think through all of these different questions. And depending on what the idea is, sometimes that idea is better to be kind of built out or incubated within a large company rather than be a standalone company. So as an example, you know, say you have this great idea, it may make more sense for it to be a feature within a company like Procore or Autodesk rather than to kind of start, you know, as a standalone company, just because if you look at, you know, the total addressable market, or if you look at, you know, what is the strategy to get that like viral growth, some types of, you know, technologies or businesses just don't make sense to kind of go down that route. And, you know, thinking about yourself as a founder, I think it's also kind of worth looking at it from a personal perspective. You know, how much time you want to spend, what do you actually want to do? Like, are you an innovator? Are you a great product person? Or are you actually a great salesperson? Because, you know, the founders, they actually spend a lot of time selling their company to everyone and talking to investors. And some of the feedback that we've gotten is that some of the founders, they actually really just want to, you know, have the idea and operate the company and, you know, build that product. So it's really understanding, you know, you as a founder, what do you actually want to do? So just going through some of the questions to think about. The key thing is, what is the problem that you're solving? A lot of the times we've kind of seen technologies look for problems, but what we've seen is the best approach is having some type of problem that you're familiar with and looking for solutions to solve that problem. What type of experience do you have that may or may not be relevant? So this is pretty key for the founder to understand kind of what may be, you know, their gaps, and, you know, and if they don't have that relevant experience, you know, being able to kind of build out a team or get advisors to help provide additional experience. What kind of company do you want to build? So I kind of touched on this before we got into the details. You know, do you want to build a lifestyle company? Do you want to build a services-based company? So kind of thinking through, you know, what is the end goal of this company that you want to build? Frankly, a lot of venture-backed companies tend technology companies, just because of, you know, the timelines, the scale, the growth, and, you know, the reasons I mentioned about, you know, getting venture capital. So really thinking through that before you take any outside capital is important. And are you ready for the lifestyle that a startup requires? You know, we're in AEC, and there's you probably have worked, you know, 7 days a week, and, you know, into the late hours of the night trying to meet deadlines and stuff like that. I would say the startup life is probably very similar, but maybe even with a lot more stress, just because, you know, you are managing the startup and you're constantly in the red, you're not profitable, you get, you know, all of the stress from your investors who are asking you, you know, why didn't you meet these milestones? Where are you at with the, you know, with the sales target? So there's definitely a lot, there's definitely a type of lifestyle that working at a startup, you know, at an early stage kind of puts forth. And you know, there's a lot of people that you could talk to about that work-life balance. Also good to think about is who may be good advisors for your company. It's great to get, you know, people who have done the whole startup thing before, or people who have, you know, particular knowledge about an area that may be relevant to the type of company that you're starting. So I kind of touch on this next one before, you know, the founder and the founding team really understanding, you know, what kind of skill sets do you lack? And then, you know, as you continue to grow, what are some of those skill sets that you need to bring in to make sure that the company and the team that you have is, you know, able to execute on all of the milestones and all of the kind of growth targets for that startup. And yeah, I mentioned this, the founder spends a lot of time selling their company and talking to investors. So do not kind of discount the whole fundraising process to get, you know, your first round of outside capital. And for the life of that startup, a lot of the times the founder ends up just spending, you know, right after you fundraise, you're basically already thinking about raising the next round. So it's kind of this vicious cycle of, you know, constantly raising money. And this is actually one of the, a lot of the feedback that I get with founders when I talk to them is that, you know, they didn't think that they would basically just spend all of their time fundraising. And it is a pretty kind of taxing process. So just throwing that out there. And thinking about your business, you know, really understanding the competitive landscape, you know, who else is doing a similar thing? You know, where are they located? You know, how are you guys tackling the problem differently? Thinking through the business model, scalability, revenue model. And there is a difference if you're kind of doing a startup, a hardware company versus a software company when it comes to scale and growth and all that. So kind of thinking through, you know, about the business, all of these different factors, because they do come into, you know, when a VC is evaluating, you know, how risky is this business for me to invest in? A lot of these things get looked at, and you don't necessarily have to have all of these kind of perfect and nailed down when you take your first meeting with the investor. And if they're a good investor, a lot of the times they will take the time to question and kind of dive into this, and maybe even make suggestions on, you know, different types of models to test out, because there are certain types of businesses that if you, for example, change it from, you know, just selling hardware to, you know, a tech-enabled contractor model to begin with, there are kind of growth opportunities if you start out the business in a certain way and then kind of change the models as you go. So when you're thinking about raising your first round of institutional capital, these are just some of the things to think about to put into your pitch. And at least for us at Brick and Mortar Ventures, we do like kind of diving into the story. And this can be kind of, you know, changed in whatever that makes the best like storytelling flow. But these are kind of the key things that we'll look at in a startup pitch. So the problem and the founding story, we'd like to hear the personal backgrounds of the team members and really get a sense of, you know, who you are. And at least for Brick and Mortar Ventures, we'll kind of dive into, you know, your experiences and kind of how you made decisions, and really try to get to know the founding team very well before we make an investment. Of course, you know, we will want to hear about the company and the product. The total addressable market is pretty important. The growth strategy, so how are you going to grow, scale, you know, anything on business development? Are you going to use channel partners? Are you going to do, you know, direct sales to customers? And then last but not least, you know, how much money are you looking for and how are you going to use that money? So kind of, you know, as you're thinking through this pitch, it's good to kind of think about the following milestones. So because, you know, raising venture capital, there's so many different, you know, series of fundings that when we talk to startups, we like to say, you know, when you're thinking about how much money you need, it's great to start with understanding what are the future milestones that you want to hit to get to the next stage, and then kind of working backwards from there and understanding, okay, if I want to get to, say, you know, $1 million annual revenue company, I'm going to need, you know, X number of salespeople. I'm going to need, you know, maybe some more technical people, and kind of backtracking from that milestone and calculating out, okay, you know, to get to there, I need X number of dollars. So that's kind of what we like to see when we're looking at, you know, funding amount and use of funds. And, you know, as you're raising your first round of institutional capital, or actually subsequent rounds too, I think it's also important to look at the investors, because the investors do end up playing a big role into how your company grows and scales. These are just some of the things that I would recommend you think about when you're talking to the VCs. So has the VC firm proven to add value to the portfolio companies that they've already invested in? So we've seen a lot of founders kind of reach out to other founders of, you know, the companies from this VC. And, you know, my sense is a lot of the founders end up being fairly open with other founders, just because it's a pretty tough journey. And I think there's, you know, camaraderie there. So really getting a good sense of, you know, whether or not this VC adds value, because a lot of the times the VCs will say, oh, we're gonna, you know, add XYZ value if you let us invest in your company. But after that investment, some of them just disappear, and maybe they're, you know, busy doing other things. So I think this is pretty important. It's good to understand, you know, how will this VC help you and your startup? So would they be able to help with, you know, the hiring, or would they be able to get you in front of customers? Where is the VC in the life of their current fund? So just as an example, you know, if they're at the beginning of their fund, a lot of the times they may be a little bit, you know, more lenient on their investments, or they just, you know, are investing in earlier stage companies, because, you know, if you think about the life of the fund and it's 10 years, that'll give the earlier stage companies a little bit more time to grow until there's an exit. So if they're kind of nearing the end of capital deployment of their fund, which is typically like 2 to 3 years into their fund life, they may end up investing in a little bit more established companies, because they may want to take a little bit less risk if they kind of understand, you know, the like portfolio landscape. So I think there's a lot of stuff to kind of think through. So this is a good question to ask the VC. Another good one is, does the VC have an understanding of the AEC space? It is not kind of necessary if they do, but I think the key question is, are they willing to learn? So because you're an AEC, you know how difficult and different all the projects are, and from one project in this market vertical to that market vertical, you know all of the different nuances when it comes to working in the AEC space. So as the venture capital firm, if they're kind of just discounting things from the get-go, probably not a great fit. But if they're willing to learn and hear from you kind of why this problem is important, or like how construction works, or how design works. I think that's very important, because the AEC space is pretty challenging, and we at Brick and Mortar Ventures do spend a lot of time trying to help other venture capital firms understand what are the challenges for the AEC space. Easy question to ask, where does the VC focus in terms of stages and check sizes? So there's, a ton of VCs out there. Some invest in super early stage, some invest in later stage. Some, have very strict requirements of, oh, we only write, $3 to $4 million checks. So it's good to kind of at the beginning kind of understand, whether or not they would even invest in your company. So kind of creating that filter of the VCs that you talk to. And I think this is something that a lot of people forget to ask is, what is the VC firm's deal flow process? So from, the initial meeting to getting money in the bank, what is that process? Because this is a different process for almost every VC. Some of them will just do an initial meeting, and then if it makes sense, they'll do another meeting with, all of the partners. And then it's like, oh, if they like it, then they'll do, term sheets, wire money. Some of them have, maybe a longer process, or maybe they, want to talk to customers. For us here at Brick and Mortar Ventures, we do like to spend the time to get to know the entrepreneurs and work with them and really prove that we are a value-added investor. So the steps that we take tend to be longer than a lot of generalist venture capital firms, but our goal is that, for every meeting that we take with you, we know that your time is valuable, and our goal is that we are able to provide some type of value back, whether it's introductions or providing insight on, the landscape of the construction tech space. So this is a really important kind of question to ask the VC. And if you're raising money from CVCs, these are some good questions to ask. Does the group have experience working with early stage startups? So a lot of the times we've talked to startups who received funding from a CVC, but the CVC is new, and they don't have any experience working with early stage startups. So they may, request outrageous things, or they may, push startups into working, into like pigeonholing their products. So there's a lot of kind of things that can go wrong with some of the CVCs that don't have experience working with early stage startups. So I think this is really important to ask. Not saying that, if they're new, they are bad to work with. It's really understanding, do they have a process in place? And, how nitty-gritty in the details may they get into. So I think just having a general understanding of, what you can expect when working with the CVC is important. It'll be good to understand what their strategic initiatives are, just to see if, there is a match, whether or not you can help, if kind of depending on, what the CVC's kind of goals are, they may or may not care, if there is an overlap with strategic initiatives, but still good to know. Are there any exclusivity agreements? I think this is the biggest one. If there is a startup that has some type of exclusivity agreement with some large company, a lot of the times, that may be a red flag to competitors of that large company for utilizing this startup. And also from a institutional investor perspective, that exclusivity agreement basically tells us that you've decreased your total addressable market, because you can't sell to the competitors of this large company. So this is one that you really need to look through the terms and understand, if you're working with a big company, that they don't have any exclusivity agreements, or maybe if they do, it's for a certain period of time. That makes sense. So this one is a little bit tricky, and we're happy to kind of provide any type of insider feedback when it comes to exclusivity agreements. We've seen some good ones, we've seen some bad ones, so happy to share here. And there's definitely a lot more questions to ask, and definitely reach out as you're navigating this, and you know, it doesn't necessarily need to be now. It could be, you know, after you've had, you know, pretty deep conversations with the CBC. We're always happy to kind of provide any type of feedback here. And that is it. I think we can open it up to questions now.